Welcome to Adelaide Capital's webinar with Surge Energy. Surge trades under the ticker symbol SGY on the Toronto Stock Exchange. Surge is a medium and light oil company with premium assets in both Saskatchewan and Alberta. Presenting today from the company will be President and CEO Paul Colborne and Derek Christie, Senior VP of Geosciences. As always, the presentation contains forward-looking statements. Paul will start with the company presentation, and there will be time allotted for Q&A. Please enter your questions in the question box or email me directly at jessica@adcap.ca. Paul, go ahead.
Guys, thank you very much for the invite today. We're excited to present in this format. It's awesome. We have a short, about 17, 18-minute presentation. I'm joined by Derek Christie, our Senior VP of Geosciences. We're so excited today. Kind of our 2 to 3 year plan of dealing with the crisis, everything has come to fruition. And right now, our goal at Surge is to be the top performer in Canada of the intermediate oil companies in total rate of return this year. And in the first 3 or 4 weeks of the year, Surge is leading the pack in all of Canada. What's our advantage? Why buy Surge? This slide is really important. I'm just a corporate finance lawyer by trade. So I've been fortunate enough in my career to build 4 of the top public oil companies in Canada with 4 different management teams. Derek, in a prior life, was one of my partners. So I'm just a lawyer by trade. How have I been able to do that? And what I found out is, as great as I can say I am, or Derek can say he is, owning elite, conventional, large oil in place, high quality, light oil, medium oil reservoirs that are low cost, low risk, low decline, wildly outperform deep, expensive, tight reservoirs that have steep declines and don't waterflood. We then are very disciplined to infill, step out, waterflood, and get our elite reservoirs in the harmonic part of the decline curve. We've done it over and over again. And really the key for us is, you'll see in a slide or two, we're written up now by virtually all the firms that cover us, 11 brokerage houses, as having the best free cash flow yield in our space in all of Canada. And think of free cash flow as the new earnings in our business. So Surge has the best free cash flow yields in the business. We're generating the best cash after our capital in the industry. So here's our numbers for the year. They're peer best, we think. So at today's prices, we would have over 300 million of cash flow, but at 75 oil, 255 million of cash flow, over $3 a share, 131 million of free cash flow above our capital. And because we have these low decline, high quality assets, it only takes us $124 million of total capital to drill our 67 wells and stay flat, our production flat. We're currently already doing our production average rate for the year and exit. This I'll quickly touch, but this has never happened in 120 years before. We've undercapitalized the most important economic commodity in the world for coming on 7 years. So you're now seeing the lowest inventory levels since 1971, with oil consumption back already to pre-pandemic levels at over 100 million barrels a day, and OPEC with no excess supply under the ground, just maybe 1 million or 2 barrels rattling around there. So it's never happened. And you see crude spiking on a straight supply demand analysis. Bottom line, we're in a massive world shortage of oil. You saw the numbers. I don't have to tell you, people are nervous about inflation. Where is the place to be in inflationary times? Oil. Oil is a great hedge. It's nominated in US dollars. It's proven time and time again during inflationary times to be one of the top performing sectors. It's a great place for investors to rotate into during an inflationary period. One thing that Surge has also done, so we have the elite assets. Derek's going to walk you through some of that in our Sparky play in Southeast Saskatchewan, 2 of the best plays in all of Canada. But one thing we did that a lot of our peers didn't do, we dealt with the major Canadian chartered banks leaving the space, reducing capital exposure. And just before December, before Christmas, in second week of December, we announced that we've closed $130 million 5-year stable term debt deal with 2 big pension funds. And we paid off all the recalcitrant major chartered banks who want out. And now by the end of this year, we'll have the major chartered banks out of our business totally on a $150 million line. Okay, I talked to you about having the best free cash flow yield. This is an independent study just out by Peters and Company. In our peer group, that we are by far the lead. Some of these companies ahead of us are either bigger than us or gassy or not really in Surge's group. But Surge has at today's price almost a 35% free cash flow yield. So that means after our capital, at 75 WTI, we're over a 25% free cash flow yield. So oil's up big again today, over 85. Surge is peer group leading free cash flow. Now, what does that mean? So it means we're sitting here and trading. There's a new study out by National Bank on the bottom here. A lot of our peers are trading at 6, 7, 8 times their free cash flow yield, their free cash flow per share. Well, Surge is trading at 3.98 times our free cash flow per share. We love that. And that's actually at the $75 case. It would be even better than that. So what we're thrilled about is there's a lot of upside in our stock as we just trade up to where our peers are. And another way of looking at it is Surge can buy its entire market cap back in less than 4 years out of free cash flow.
Hey,
I made a bold statement. I'm going to let Derek talk to it. I said to you, Surge has a peer group leading high quality asset base. And when I say that, I mean huge oil in place, 2.6 billion barrels of oil in place, only a 6% recovery factor. But now, with that great lead in, I'm going to let Derek explain why that's important. And it's one of our biggest distinguishing features as a company and to why investors should want to own Surge. Derek?
Okay, great, Paul. Thanks. So this slide really shows the advantages of conventional reservoirs, and particularly ones that Surge is in. You can see how it compares to some of the tighter unconventional oil plays, being the Duvernay and the Permian. We're focused on the conventional side. Really, that helps us to have lower capital costs, a better decline profile, and really improved oil recoveries and superior economics. This next slide really shows the depth of our oil in place and our location inventory. So Surge has a deep inventory of over 950 drilling locations, which provides us with a low-risk 13-year drilling inventory. We control many large oil in place pools that total over 2.6 billion barrels of oil in place. And these reservoirs have a very low recovery factor of 6%, which again provides us with a low-risk path to additional recoverable oil. And I think the main thing to take away from this is that small changes in recovery factors of large oil in place pools provide for significant changes in recoverable oil, and Surge has that benefit. Next, I'll talk about both our plays in the Sparky and Southeast Saskatchewan, which are ranked as 2 of the top 5 conventional oil growth plays in Canada. We're highly focused in our 2 operating areas of Southeast Saskatchewan and the Sparky. These 2 areas account for 65% of our production and 85% of our capital in 2022. And again, both of these areas provide exceptional economics, and we have a deep inventory of drilling locations and prospects. Here we have our 2 top core areas being the Sparky and Southeast Saskatchewan, and show where they rank based on some independent research that's been put out by Raymond James. So you can see that our 2 plays rank in the top 5 of all of the plays in Canada, and that is on a basis of when the wells reach a 2 times payout. So the well's drilled, it's paid out, and then when does it reach a second payout? So very critical to the long-term economics of an oil play. So this shows where we rank in that. And again, I think one of the big things to take away here is that our deep inventory of 950 drilling locations, 2/3 of those locations are within these 2 plays. So we have a great runway to continue to show organic growth. A little bit more on the Sparky. So the Sparky play is part of an 11 billion barrel oil fairway in central Alberta, with 7 being in the heavier window and 4 being in the light medium window. Surge is really focused in that light medium window, and we control over 800 million barrels of oil in place in that trend. It's extremely de-risked because we have over 20,000 vertical wells that have been drilled into the fairway, which really de-risk the play. And then through that, Surge has developed an integrated reservoir model that utilizes detailed geological mapping, 3D seismic, and production data, which has resulted in a predictable, consistent, low-risk inventory of over 400 drilling locations that, again, provides us with organic growth and an inventory of over 12 years in the area. A bit of a snapshot of the Sparky in general. We have amassed a dominant position here, and again, 800 million barrels of oil on the Surge lands. And Importantly, we've drilled 200 successful horizontal wells that have resulted in significant production growth. We've taken the area from 1,000 barrels a day to current production of over 9,000, and the area provides significant strong cash flow with 150 million of cash flow forecasted for 2022. Jumping into Southeast Saskatchewan, really it's an exciting new area for Surge, but an area where the Surge management, including Paul and myself, have had some very strong track records of success. Companies like Crescent Point, Mission, Starpoint. The area really complements our Sparky core area very well, as it provides, again, extremely economic, cost-efficient drilling, high operating netback oil production with significant organic growth opportunities, as well as potential strategic acquisition opportunities. Again, final snapshot of Southeast Saskatchewan. These are really premium quality assets with top decile netbacks, low operating costs, very low inactive well counts with minimum abandonment liabilities. And we have over 200 drilling locations that provide us with significant organic opportunities, strong cash flows of over 100 million forecasted for 2022.
This is a slide that we thought we should put in, and we've kind of highlighted it here. I believe that Surge is a leader. I don't think we're the leader, but I think we're one of the leaders in our peer group, which is the intermediate oil and gas companies in Canada in ESG. And not talk, we've done the projects. An example is in the last 4 or 5 months, we've completed 2 gas gathering pipelines, both at by Esteban all the way up to Steelman, and in Southwest Saskatchewan on our Shaunavon play. So we've tied in over 90% of Surge's gas into pipelines and reduced our greenhouse gas emissions in the province of Saskatchewan by 90% in just the last few months. We're already abandoning 3 wells for every well we drilled. But with government programs last year, we ended up abandoning almost 5 wells for every well that Surge drills. And when I say abandon, that means returning the land back to its natural state. So that's, we think, much better than a lot of our peers have done. Furthermore, we're very, very cognizant of changes in things like board members and that. So we've now got a third of our board are high quality ladies who have great track records. Really awesome directors. So we've changed our board makeup from 9 men to nicely balanced with 3 ladies coming on our board. So we're just not talking about it. We're actually going out and doing it. And I think we're quite excited at Surge. We put out our inaugural ESG report just a month ago in December and have had a great feedback on that. So I feel like we're a leader in this ESG, and not by our words, but by our actions. So I guess in closing on the main presentation, happy to open it up for any questions. I'm very intense. I want to be the top performer in the country. StarTech Energy, Crescent Point Energy, Starpoint Energy Trust were all top performers in Canada. Surge, my first 18 months at Surge. And I'm letting you know, I really have not actually had a situation where I feel we're that set up to be one of the top performers in the country. When I say that, I mean in total rate of return over the next year, I expect Surge to be right up there with the best intermediate growth and dividend-paying oil companies in Canada. We've already started out the year that way as being a top performer, but don't take my word. Don't take Derek's word. Here's 11. There's 10 on this slide. There's an 11th firm, ATB's coming out, we think, with a strong buy on us. There's 10 of the top analysts in Canada. We're trading just over $6 a share. We have target prices up to $12.75 a share. Raymond James, big U.S. retail-based firm, Jeremy McRae, last week came out with a $12 target on Surge in the next 12 months. So it makes it very exciting for us to see these analysts. The average target price on Surge is, I think, over $10 now. And we have a couple of key catalysts that are coming out here soon. One is our new Sproul engineering report. Should be done in the next 4 or 5 weeks. We think Surge's net asset value is going to be on a 70 flat US barrel Sproul price deck. We think Surge's net asset value per share is going to be $18 a share on proven plus probable, over $10 a share total proved. And it's thrilling for me because that's really what the value of our company is, as Derek showed you on the reserves, the analysis of the reserves and production and cash flows as independently audited. Good companies will trade up to well above their P plus P net asset value in a hot market. Starting to feel like a hot market? Well, that number is $18 a share for Surge. Even if you want to take a way more conservative number, that's a $10 target on Surge. Another catalyst coming soon is our dividend. We expect to have hit our debt targets. We now have one of the better balance sheets in our peer group in Canada, with a debt to cash flow exiting the year at 0.6 times, not 1.6, 0.6 times debt to cash flow. And what's exciting is, as we hit our debt targets by around May of this year, we anticipate putting a nice dividend back in. We always paid one, and having using that $130 million of free cash flow to put in a $30 to $40 million dividend, which would equate at today's price to about an 8% yield. But it would only be about 15, 16, 17% of our total cash flow. So a pretty low payout ratio. So look for those two catalysts coming down the pipe. Derek, any last thoughts you had?
No, but we do have some questions that I'll just kind of read out and then we'll kind of address those.
That'd be perfect.
Okay, first question we have is just any further M&A potential in Southeast Saskatchewan? A lot of small private producers in the area. What do you see for M&A?
We do see a couple other companies like Adelaide. There's some smaller companies. We just completed, though, two really nice acquisitions of Astra and FireSky in the fall last year. As Derek showed you, we have over 200 drilling locations in Saskatchewan, so we don't really need to do something. But if we do see a quality asset come up that's in a private co or a format, we wouldn't hesitate, but feel pretty good that we don't need to do anything, but we're always looking for good assets. And when I say that, I mean, go back to that big oil in place, conventional, high quality reservoirs. That's a key for us.
Perfect. And then there are a couple other questions that I'll just sort of lump together. It has to do with the new drilling technique that we're using with some multi-lake potential and some oil-based mud. So that's one that I'll handle here. In parts of the Sparky play, we have identified some areas that have some really good multi-lake potential. So leveraging off of some work that's been done in the Clearwater, which I'm sure most of you have heard of, which is a highly economic play in Canada, we found areas that have very similar geological characteristics that it really didn't work as well because it is slightly thinner pay and slightly heavier oil. So it didn't work as well for our single-leg frac wells. So now we've been going in there and tackling that with some multi-leg horizontal wells and had some great success. So really what that is doing is it's taking a portion of our inventory that would have called it kind of lower tier C and D type inventory. Now it has moved that economics up to top tier for us. So it's grade A. And then on top of that, we're trying some different mud systems. Again, leveraging off the work that's been done in the Clearwater. They've been drilling quite a bit with oil. And so we drilled our first wells with gel chem and with some KCl to try to limit some of the clay migration. But using the oil-based mud system, we're seeing about a 50% increase in our production from the initial wells that we've drilled. So again, still piloting that. We're drilling 2 more wells immediately. We're on one right now, and we'll continue to do that. So very excited about what this technology is bringing to us. Doesn't really change our plan for developing the core of our Sparky with our single-leg frac wells, but it really improves kind of the edges of where we're looking, and it helps to increase the quality of our lower tier and make it top tier inventory.
Okay, great. Thank you, guys. I have a couple questions as well. Now, your stock did underperform last year. It's performing well this year, extremely well. Can you give just a little background as to why you underperformed last year, given the oil market was fairly hot?
Yeah, so 2 main reasons, Jess. I think one was the bank situation. Our balance sheet was improving, but anybody that had the Canadian chartered banks in it and a reserves-based lending, RBL structure, the major chartered banks, let's be clear, they're out. They want to leave. They want to reduce exposure. So Surge was like that. How did we fix that? In the second week of December, we closed a $130 million term debt deal that paid out all the recalcitrant banks and remove that risk. So we've given complete financial clarity to the market on our situation. We have one of the best balance sheets with low debt to cash flow, but we also have reduced our number of lenders from 10 to 5 and paid out all the banks that wanted to be out. And now we've locked up with some big pension funds, 5-year term debt money, stable, solid cash flow that's locked in for 5 years. So that was one great piece of business. Second thing is we bought 2 private cos in Saskatchewan in the fall, and those had private equity shareholders, and they were locked up, but they came to us and said, we were selling some stock that we're allowed to sell. Could we sell more? So in the fall, late last year and early this year, we had some amazing days where we traded huge volumes of stock. We traded out all the private equity funds that wanted to trade. Peters and Company helped, National Bank helped, Raymond James, and we block traded all those private equity funds out that were selling our stock or wanted to sell. So that stock is now all in good hands and out of the way. And I think it's now been like a relief valve on our stock. People are going, man, Surge is trading at 1.8 times cash flow. Usually it would trade at 4.5, 5 times. That's, at $3.06 a share at 75 and $3.30 a share, cash flow per share at 80. This stock could be 10, 12 bucks. And I think it's going there. So those are the 2 things I think kind of held back the stock in the fall.
Thank you. And on your talking about recovery factors on the Sparky, on the water flood, if you can give a little color, right now you've got them booked at 8%. Analogous fields have been as high as 20 to 30%. Do you see that being possible for your water floods?
Yeah, I'm going to let Derek finish. I'll just say we think the Sparky on primary is easily 10, 12%, maybe 14, probably 12. But then under water flood, our Wainwright field is a poster child for a beautiful 300 million barrel in place Sparky pool that's it's already at a 37% recovery factor and a profit to investment ratio, which means you got your money back 16 times and it's flat production under flood at 37% recovery.
Yeah, and I think I would just follow up with that. So we are definitely committed to the water flood in all these areas because we've had such great success. So we're continuing with that. As Paul said, we have great primary, and then we're continuing with the secondary recovery in the Sparky. And then I would also throw in Southeast Saskatchewan. So we have some great water flood opportunities there as well. It has a very active water drive. So there's some areas where you don't actually have to water flood it, but you get recovery factors that can, approach 30% and even higher in some cases. But we have some conventional Midale pools as well that we will be flooding. So we have a number of pools that we are continuing to flood, and we're very committed to that because it helps to lower the decline and just improves the recovery factor.
Okay, great. Thank you. Now, obviously, we all feel pretty bullish about the oil scenario. Let's say doomsday happens and we do see a drop in price. What's your break even for your current capital program? I guess, including a dividend, if you're putting one in, as you had alluded to.
Yeah, so our current break even, and we don't have a dividend in yet, and I wouldn't, our board has to approve it, but our current break even has gone from like $58 WTI 2 years ago. And right now we're probably less than 45 WTI, where we could get our entire capital program off, stay flat at $45 a barrel WTI. And crude, as I came in, is up another $2 to over $85. So I think we're really safe on our capital program there. Obviously a dividend would raise that up a little, but we're talking about putting as little as 15% of our total cash flow into the dividend, or 30% of our free cash flow. The beauty of that is it's $40 million if it's 30% of our free cash flow. So it's a meaty dividend, but the board has to approve that. We're just right now analyzing where we would put the dividend in, but it's probably somewhere between $30 and $40 million a year. And if you do the math on 84 million shares, that's probably an 8% yield at where we are now, and probably bodes well for our stock trading up to that $10, $12 mark.
And we did have another question from the group here. So can we talk of current production rates, and are they above the 21.5 guidance?
Good question. Until the cold snap that happened a few weeks ago, I'd say we were above the 21.5. We had 1 week that was well over 22,000. We got hit with a bunch of downtime in the cold snap. I think we're rallying back quick, and I'll even let Derek mention we have 3 rigs going with some early spectacular results. So I think it's safe to say we're at the exit rate for the year. We beat it. We were definitely over 22 recently. The cold snap knocked a week or two off us, but I think it's safe to say we're in that 21.5 range. We have 3 rigs going, Derek.
Yeah, for sure.
Good success.
So, thanks, Paul. So, off to a very strong start in 2022. As Paul mentioned, we have 3 drilling rigs running. We have 1 in Southeast Saskatchewan and 2 drilling in the Sparky, 1 drilling single leg laterals, 1 drilling multi-leg laterals. The production results from those are just starting to come in as we're starting to get the wells completed. The wells in Southeast Saskatchewan really far exceeding our type curve expectations for the first couple, and then just getting our first frac Sparky well pad on with not production yet. So again, looking great. So even the numbers that Paul's talking to do not have much of the recent drilling factored into that current production level.
And one other question I have is just with your free cash flow, even if you do implement a dividend, would you look at buybacks? Would you look at adding a small wedge growth? And if so, how much?
Yeah, good question. That's when you have that much. I've never actually had a company with this much free cash flow. If you take current spot prices, it's about 175 million of free cash flow. 80, it's 150, 75, it's 130. Let's just use the 130. If we put a dividend in that's, let's say, 35 million, still going to have like over 90 million of free cash. A growth wedge at about 2.5% growth wedge in would be about 15 to 20 million. And share buyback, we've always had one there. We're trading at basically, I think, less than half our net asset value. Our new Sproul net asset value, we think is going to be $18 a share, proved plus probable. $10 plus on a proved basis, and that's at a 70 flat price deck. 70 flat is what Sproul's using. So net asset values would be much higher at current strip is around 80. So I think we put all those in, a modest growth wedge, first a nice dividend, a modest growth wedge, but only 2.5%. We want to keep our decline in that harmonic part of the decline curve, and then a share buyback with special dividends being spiced in there. If the commodity price is higher than our budget estimate, maybe every quarter have a special dividend, somewhat similar to what Tourmaline did here recently.
Thanks, Paul. And just a quick question on your hedging strategy. Obviously, the hedges you were forced to have on last year were horrendous. They've all rolled off. What's your hedging strategy for this year?
Yeah, the hedges last year were horrendous. The major chartered banks forced us to hedge fixed price hedges at 47 WTI as crude started to rally back in late 2020. Those hedges, they were horrible, are all done at the end of 2021. So an example of the torquiness and surge, our cash flow goes unhedged cash flow in January of last year was 6.9 million. This year, it's 28 million in the month of January, unhedged cash flow. So what we're doing now that those hedges have run out, that the banks forced on us last year, we're now layering nice hedges in with a bottom around 60, 65. And a lot of times we're doing costless collars where we keep the upside up to 80, 85. We did a recent couple here, costless collars that I think were 65 by 85 WTI. So we're doing hedges that lock in that downside, lock in our capital program, but let us share in the upside to the price. Even today, we would still be in the money at 85 on some of those. So yeah, we're rehedging. Our goal is always to be about 50% locked in of our net after crown volumes. And we're kind of working towards that now. But our hedges are $20, $25 a barrel higher this year than they were last year.
Okay. And I don't think you guys have any egress issues on where you export your oil.
No, we trade with all the major, like with Shell, with Macquarie. We have with BP, no problem in any of our areas. We're even with the Saskatchewan acquisitions, we've done 5,000 barrels a day downstream of any apportionment issues. So every day we market our 21,000 barrels a day, no problem at all.
There was a couple other questions here, Jessica.
Yes. Go ahead if you want to.
Yeah, sure. So one was long-term, are we planning on increasing production? I believe that was answered just with the capital allocation with the free cash flow. And anything else you want to add with that, Paul?
Yeah, I'd say Surge is one of the companies. I love our size. We're not small, but we're not CNRL. So the minute we decide to put our foot on the gas pedal, we can grow. And I could easily walk down the hall and say to Derek, you've got 20 million extra and add a growth wedge. But we want to stay disciplined, as I say, harmonic. In the harmonic part of the decline curve, that means the low part of the decline curve. So our growth wedge would never probably ever exceed 5%. And we're kind of looking at probably 2 to 3%, say 2.5%. And that's around a $15 to $20 million touch for surge on capital. So we have no desire to be a big growth company like a Headwater or some other companies that are out there. We love our model. We've got a 14-year inventory. We want the dividend, special dividend, share buybacks. So no big growth. We're not going to change our colors, our spots now, right now. We're dedicated to this model. And really all I'm doing, and Derek, is we're pushing today's price. We're pushing out a 35% free cash flow yield to all of our investors. One of the highest you saw on that Peter slide in all of Canada. We're pushing it out until May through debt reduction, which increases all of our net asset values per share. Then in May, we'll start with the dividend, a small growth wedge, the share buybacks. So we'll change the mix of it, but it doesn't change the fact that as of today, we're pushing out a 30+% free cash flow yield to our shareholders.
Okay, and then we have a couple other questions. So first one is, are we going to drill on any other well sites apart from the Sparky in Southeast Saskatchewan? The answer is yes. So as part of this program, we do have a Doig well planned that will spud kind of late Q1, early Q2. Very impactful well. These wells are, they can come on 1,000, 1,500 barrels a day. We don't drill a lot of them. We'll drill like maybe one every year, but it helps to really keep our production facility full up there. So again, really excited about that. Haven't talked about it very much, but that's one well we're planning. And then we also have a couple wells planned in our Sawn area, which are offsetting a couple injectors that have been on injection for quite a while. So we're really expecting some great results out of that as well. So as I mentioned, 85% of our capital is in those two core areas, but we do have some capital spending in both Valhalla and our Greater Carbonate Sawn area.
Hey, just one question about the interest rate on your debt. Is there any way to lower that? I just wanted to touch quickly on the banks are running still at $47 flat pricing, right? So a lot of your line would have been non-conforming. So what were you paying for an interest rate on the non-conforming part of your bank line before you restructured your debt?
Yeah, we're actually thrilled at our interest rate of 8.85%. It's one of the lowest. A company like Surge's size very seldom gets access to term debt on reasonable terms. For example, our rate is better than Baytex's rate, which they're a 75,000 barrel company. Our equity cost of capital, if the new Sproul engineering is your test, and our net asset value per share, P plus B, is $18, our even total approved is over 10 on a 70 flat price deck. Our equity cost of capital is probably around 40, 45, 50%. So if I can lock in term debt at 8.85% for 5-year money and go drill 200% rate of return wells, which to Derek's point, our program at today's price, the wells are over 200% rate of returns. 8.85% money is really, really good and cheap. And to Jess's point, we're already borrowing at around 5.5 to 6% from the banks. So the delta is only $1.5 million a year to Surge to take all the recalcitrant, unruly banks out on a cash flow of today's price is $300 million, but say $275 million in cash flow. It only costs us $1.5 million a year to lock in that nice, stable 5-year debt.
Without any restrictions.
Yeah, with no restrictions.
Yeah. And now a lot of your peers are actually reaching a point with oil prices where they are of taxability. Where do you stand on that as far as your tax pool situation goes?
That is another benefit. We should actually put it on a slide. Surge has over $1 billion. We have $1.1 billion of tax pools. So the dividend model, our operating model of those elite water flooded, low decline assets, but B, our financial model of the increasing compounding dividend, plus the tax pool coverage we have about a 5-year tax horizon at Surge with over 1.1 billion of tax pools. So we'll be able to shelter a lot of that free cash flow away from Justin Trudeau and be able to distribute it out through dividends on a tax efficient basis to our shareholders for the next foreseeable future. So I'm glad you brought it up, Jess. We don't even put it in, but we have over 1 billion in tax pools at Surge.
And one other question I have is, obviously with inflation on pretty much everything, and we've also have a shortage of people in the service side of the industry because of the downturn. How much cost creep are you seeing? And how have you prepared for that?
Yeah, that's a great question. So going into this year, we've kind of planned for a 10 to 15% increase in the drilling costs that we have seen. So that's exactly kind of the number that we're seeing from our actual costs that are coming in for Q1. So very comfortable with that going forward. We've done what we can to do things like pre-buy some casing and kind of take some things that are in our control so we can control those costs. And then again, the advantage of us starting up, we started up in December so we could get kind of the rigs that we wanted to make sure that we're the most efficient that we can be. So that's really how we're dealing with it. All the numbers that you're seeing are including that 15% capital cost increase year over year.
Okay, great. I think those are all the questions I have. If the audience doesn't have anything else, I think we are almost complete. Any final words you guys would like to say?
I guess I'd like to just leave you with our goal is be the number one performer in total rate of return in our peer group in Canada. And when you see those 11 or 10, soon to be 11 analysts with target prices up to $12.75 a share came out recently. Raymond James with a $12 target on Surge last week came out. We're just thrilled by it. And it's one of the most exciting times we've ever had because I've never had that much free cash flow. In the past, we would always put it into the ground or raise the dividend or whatever. So it's a thrilling time for us. All we got to do now is go out and execute and to have the banks out of our business and offer that financial clarity together with our high quality asset base. I think that combination is what will lead us to be the top performer. And we're really hungry to go deliver it.
Terrific. Well, thank you, gentlemen, for your time. And we'll leave it there for today.
Great. Thank you.
Thank you, guys. Appreciate
Thanks.
the time.